The Bank of England has put a freeze on interest rates in the UK, ending a run of 14 straight increases in its battle to tame inflation. In a surprise move, the central bank left rates unchanged at 5.25%, saying there were increasing signs that higher rates were starting to hurt the economy. The decision comes a day after figures revealed an unexpected slowdown in inflation in August. It fell to 6.7%, down from a high of 11% nearly a year ago. The base rate has risen from 0.25% last January to this current rate, which is harsh for homeowners, but something that many economists say is necessary. Well, let's talk now to Mark Oswald, who is Chief Economist and Global Strategist at ADM Investor Services International. Good to see you as always, Mark. Thanks for joining us. So this is something of a surprise hold from the Bank of England, isn't it? What were they thinking?
Well, at the end of the day, the move down in inflation that we saw yesterday, which was above all driven by falling food prices, finally. It's taken some time, but the effects are now, and indeed falling services prices, particularly for things like restaurants, hotels, travel. I think that's started to ease some of the pressure on services inflation, which is the key element which they were worried about. They mentioned also that wage growth remains high, but I think they recognise, or one should say the majority, and it's a very slim majority on the Management Policy Committee, because the vote was only 5-4 to hold rates, the rest voted to hike, that the wage growth is partly structural and it's also a lagging indicator. And as they mentioned themselves, other indicators of wage growth have actually turned lower. And the labour market has started to loosen. So I think it's a combination of things. At the end of the day, would it have been worth it doing another 25 or even 50 basis points in terms of raising rates? Probably not. When you've done 515 basis points of rate hikes, the next 25 or 50 actually aren't going to make a whole load of difference in your battle against inflation. The real battle is actually holding rates at a level until you see that inflation come down to their target.
So do you think we have now seen the end of rises, both for rates and also inflation?
I think the inflation won't be a straight line. We've got some emergent renewed pressure on oil prices, which will definitely hit pump prices, gasoline pump prices. But it's on the way down, no doubt about it. As far as rate hikes go, unless there's a very nasty surprise from energy prices, which there could still be, and that's not just in the UK, it's anywhere in the world, I rather suspect we stay at this level, and we stay at this level for a considerable period of time, quite possibly all the way through to the end of next year.
Let's talk about the United States then, where they've also kept rates unchanged. What can we read into that decision?
Well, it was a double-edged sword. Yes, they didn't raise rates again. They still are, however, hanging the prospect out there of another rate hike before the end of the year. More importantly, they signaled basically that whereas at the previous meeting, they were looking at up to 1 percentage point in the way of rate cuts, they're now looking only at 50 basis points in the way of rate cuts next year. That's basically telling people, look, the economy's doing well, and they basically took the focus away somewhat from inflation to the very tight labour market and a better outturn than they'd been expecting in terms of growth at the moment. They upgraded their growth forecast for this year and for next year. Not that one should sort of really get too excited about it. We are only basically talking about 2.1 for this year, but they were originally looking only at 1.
So they might have put inflation on the back burner, if you like, but the Fed chair mentioned that the pace of inflation is slowing. Is that just down to those rate rises, or is there more to it?
It's down to easing pressures on auto prices. It's down to, above all, easing pressures in the housing market. Unsurprisingly, that would definitely be a knock-on effect from the rate hikes. Mortgage rates in the US have risen very, very sharply. So there is some impact there. I think personally that they're looking at they're being a little bit too optimistic on the economy. The threats that are imminent, both government shutdown, the restarting of student loan repayments, the auto workers strike, all basically mean that they are going to have to tread very carefully as we go forward, and their views on the economic outlook could change quite sharply, particularly if the auto workers strike goes on for quite some time, and indeed there is a protracted government shutdown.
Mark, good to talk to you. Thank you for joining us as always. That's Mark Oswald from